Hello, everybody, and welcome back to another episode of the Rogue Agent Answers. My name is the Rogue Agent. Some people call me David Lewis, and every week I answer one of the many life insurance related questions that I've received from clients, from email subscribers on the daily email list. Questions floated to me from across the interwebs, in the comments sections, which I know you're not supposed to read, or just interactions that I've had with people in real life over the past 20 years, which is a long time. And some of these questions I just scribble down on scrap pieces of paper. Some of these are stuff I've written down on my phone. Some of it is on Post-it notes scattered all over the office. And every week I answer one of those questions. So if you'd like to ask your question, drop them in the comments section or join my email list for more life insurance tips and advice at monogenics.com. monegenics.com. Also, keep in mind that nothing in this podcast is or should be construed as financial, investment, legal, or tax advice. In fact, nothing that I say in this podcast should be construed even as insurance advice, as I don't give individual advice blanket just across the internet unqualified to random strangers. So if you need any of that stuff, contact a licensed professional that you know, like, and trust, preferably someone licensed in your jurisdiction. And now for this week's question. Do I need to use a term rider or a term blend in order to get the most efficient whole life policy? So this question is in reference to using term blends on I think on most policies, but this one specifically references New York Life's policy, their whole life policies, and their what they call their dividend option term or DOT rider. So the question there's some backstory. I'm just kind of shortcutting to get straight to the question, but there's actually references a post on the Visible Policy, and which is a kind of a long-standing commentary on this guy's New York life insurance policy that he purchased from a New York Life agent, and how the policy has performed over time. The commentary or the quote here from the Visible Policy site, it says, "Your policy has performed better than a lot of regular whole life policies I have seen because you use the OPP rider." The OPP rider is in New York Life's lingo, it's the option to purchase paid up additions. Use the OPP rider to overfund the policy. However, you could have made it even better when you purchased the policy many years ago. What you have been using is the unscheduled OPP rider. A better way is to use the scheduled OPP rider combined with the DOT rider with a very small base amount. Most of the commission and the company policy fees are based on the base amount. So if you had made the base amount as small as possible, the cash value growth would have been much more efficient. There's that word, efficient. For example, when you first purchased the policy, you can make the whole life amount, a base amount as $25,000 and add a DOT rider as $225,000, so that the whole life total face amount was $250,000. In that case, you might have been eligible for the preferred class at that time. The commission and expense would be minimized. Your base premium would be very small, and you can direct the remaining premium dollars to the scheduled OPP. You would still pay the same total premium, but the cash value growth would have grown much faster because of the design of the policy. This is so that's the quote. Basically, there is this idea in life insurance of design efficiency, of how you get the most efficient life insurance policy design, and this is at least in whole life insurance, is one of the most, I think maybe, I don't think it's the most, it's definitely one of the most misunderstood aspects of whole life insurance. And a lot of the agents on YouTube and TikTok and I don't know, Instagram or wherever else they're putting up these videos, they're very poor at explaining how this actually works. Ironically, because they're pitching themselves as being specialists in whole life insurance. This whole idea of efficient policy design has to die. It has to die. I'd say myself, because in the past I've used the word efficient, like doing an efficient design, but it's really not a matter of efficiency or inefficiency. basically the way that whole life insurance works is you don't make whole life insurance more efficient. It's not as though whole life insurance is an inefficient type of policy. It's as efficient as it needs to be in order to do the thing that it's supposed to do. So every single whole life policy works the same basic way. And the short version of that is that you have the policy set up, premiums go in, expenses come back out, and then whatever is left over gets credited with interest and dividends from the company performance, however much they can pay, however much the company can afford to pay in dividends that year. Now, when the company is designing their product, it has to do certain things. So the premiums plus the interest that they credit minus the expenses they got to take out and everything, that has to equal a certain amount. And the cash value that gets put, everybody knows cash value and death benefit, associated with a whole life policy. Well, what most people don't realize is the cash value of your whole life policy has to equal the death benefit at age 100. In some policies, they stretch it out to age 120. But to just take a simple example, the cash value must equal the death benefit at age 100. That's when the policy endows. And that's essentially when the policy is over. And, the contract is completed. There's nothing left to do for the insurance company except just maybe hold the money, for you until you die. So it's not a matter of efficiency. It does exactly what it's supposed to do on a predetermined timeline. It can't move faster than that. It has to move at that pace. It's never going to move at a faster pace. It's a picture like a bucket, right? Except it's a timeline. Whatever age you are now to your age 100, the cash value is going to grow at a pace that is required to equal the death benefit at your age 100, and it's never going to move any faster than that. It's going to move at a predetermined. That's kind of what's one of the things that's kind of a benefit of whole life insurance. It's stable, it's secure, it moves at a predictable pace. It has to do something it has to do that on a set timeline. It can't move faster and it can't move slower than that. It has to move exactly at that pace. That's it. You pay the guaranteed level premium. You get a guaranteed cash value that increases every single year. You get a guaranteed death benefit, okay? The difference between the death benefit and the cash surrender value is what the insurance company will call it the net amount at risk. It's pure insurance. Every year as the cash value goes up. So the cash value is not just like savings or money that's just set aside there. The cash value is actually the cash reserve that is set aside to help pay for the future death benefit. So every year, when people tend to think of like the death benefit and the cash value being two separate things. They're not. The policy is indivisible, okay? The death benefit is comprised of net amount at risk and cash surrender value. That's how they design it. You ask any actuary, you ask anybody at the life insurance company, ask everybody except the insurance agent. Anybody who designs it and understands how the product developers and so on and so forth, they'll all explain it to you the same exact way. It's cash value plus net amount at risk equals your total death benefit in a whole life product. That's how it works. As the cash value increases, the net amount at risk decreases until all of the pure insurance is replaced by cash value. In other words, until the cash value equals the death benefit. The death benefit is not like a separate thing that you get. The death benefit is the total net result of those two combination things of cash value and insurance. You don't get, but it's nonsensical to talk about them as two separate things. They're not. They're indivisible. It's part of a whole. The death benefit is part of the whole. It's basically the sum of the entire contract. So you have to think about it that way. The death benefit is the sum of the entire contract. Now, how do we tell what is this business about making it more efficient? You can add a term rider and somehow this makes it more efficient. No, a term rider adds to the cost because you're adding additional coverage. So if you add a term rider, in the case of New York Life, but it works the same way with all of the carriers. You are adding, if you say, I want to elect dividend option term, it means I'm going to use some of my dividends to buy 1-year renewable term insurance. You are adding coverage, which means you are adding cost. You're adding, period, end of story. You are adding cost. Why would anyone want to do that? The reason somebody wants to do something like that is because when you have a higher death benefit, what it allows you to do is it allows you to buy additional life insurance, additional paid up additional life insurance, or PUAR. In New York Life's parlance, they call it option to purchase paid up additions. It's additional life insurance, additional paid up life insurance. It's a single premium policy, a single premium block that then gets stacked on top of the base policy. So you are buying additional insurance, paying a single premium. You could do this every year. You can buy multiple. You say, I'm going to buy, or multiple times in a year. You could buy small blocks, buy additional paid up insurance, and stack them, keep stacking them on top of your base. Each one is doing each block of insurance, paid up insurance that you buy. Again, it's not that it's more efficient, less efficient. It's as efficient as it needs to be to do the thing that it's supposed to do. So a single premium whole life, what they do is they take the premium and then subtract out all the charges. Again, it's premiums in, expenses out, whatever's left over gets credited with interest and dividends. So they take the premium, they deduct the expenses, and then whatever is left over, the cash value is left over, they figure out how much death benefit that can purchase with whatever guaranteed interest credits that is left, or whatever cash value is left over. Whatever the guaranteed interest that gets added to that, they figure out how much death benefit that can buy over the next, however long, out to age 100, because that's when your policy matures. And then they just, you give them the premium, deduct the expenses, and then it purchases a death benefit that requires no other future premium payments. That's it. Just a single premium payment. That's what paid up additions means. And so it's not more efficient. It's not less efficient. You're actually, if you want to think of in terms of efficiency, it's actually less efficient because you're not getting very much death benefit for the premium. What you're getting is a lot of cash. It's a cash-rich addition of insurance, which if you're not trying to build cash surrender value, that's a great thing to have, right? As far as the expenses are concerned, the expenses are going to be proportionally lower because there's not a lot of insurance being purchased on a paid up additional life insurance policy. So, but that doesn't change the overall expense structure of the thing that you're buying. So base whole life is going to cost whatever it costs. The paid up additions is going to cost whatever it's going to cost. And it doesn't speed up the cash value. It doesn't actually make it more efficient by somehow lowering the cost of the base or lowering the cost of the policy. What you're doing is just buying additional insurance, and that insurance comes with its own cash surrender value. Now, the benefit of doing that is that because you're buying single premium policies, you're not spending proportionally. You're spending less on death benefit, so that you get more cash, which is what a lot of people want out of the paid up additions, and what they want by doing the term blending is they want to be able to buy more paid up insurance, and you get less death benefit, but they want cash. Right. And then they want the insurance company to keep crediting interest on that every year so that hopefully the thing grows. They keep buying paid up additions and then it earns interest. And that interest and dividends can then be recycled back into the policy to buy even more paid up additions. And it just keeps growing and growing and growing. So it's not the cost of the policy doesn't change when you do this. OK, it's nonsensical to talk about efficiency. What you're doing is you're allowing yourself to buy more or additional paid up life insurance. That's all you're doing. And by buying additional paid up life insurance, that is what's helping to increase your cash surrender value. The company is still crediting like the same amount of interest. It's deducting the same amount of costs and so on and so forth on the base. And even for the paid up additions, there's still an expense being deducted from that. And the expense is going to be whatever it is for the paid up life insurance policy. In other words, the cost of insurance, the COIs, don't change on a per thousand of coverage. It's not cheaper to buy. It's not cheaper on a cost per thousand of insurance to buy paid up additions because the mortality charges are the same. The mortality charges don't change because you buy a different type of life insurance or because you're buying it in a different way. Your mortality risk is the same. So then the cost of insurance is the same. Now, agents do earn a lower commission on the paid up additions part, largely because the cost is because there's not as much insurance and there's other factors that go into the PUA rider and stuff. So the agents just aren't earning as much as they would on the base. The base gives them like a much larger insurance amount, and that larger insurance amount has, of course, all the costs that are wrapped up into it. It's a bigger cost because you're buying more death benefit. More insurance. So to the extent that there's you're lowering the cost. You're lowering the cost because you're reducing the amount of insurance that you're buying. But otherwise, the cost per thousand, the mortality charges, the cost of insurance isn't changing. The total cost may change because less insurance is being bought. Otherwise, if you were to look at it on a cost per thousand, your COI charges don't, again, on a per thousand basis, aren't changing. So it's not as though the policy is quote unquote efficient. It's not as though if you didn't do that, it's not like it would be inefficient or less efficient. It's doing exactly what it's supposed to do. The base policy is doing exactly what it's supposed to do, and it does it very, very well. Specifically so I hope that addresses the issue of efficiency. The idea of trying to minimize the base, especially at a lot of carriers like Guardian and Penn Mutual and New York Life. Well, Penn Mutual and Guardian, the two companies that a lot of the IBC guys love to use, Lafayette and Mutual Trust Life, and a couple others that the IBC guys love. But especially at New York Life, if you do this, there's a trade-off. So they say if you lower the base, you're going to make it more efficient. It's going to build cash value growth. It's going to be much faster and all this other stuff. There's a price to be paid for that. So at New York Life, New York Life is not special in this. Every carrier has limits on the amount of paid up additions that you're allowed to purchase. And those PUA rider limits are tied to, wait for it, your base policy. So the lower your base policy, the lower your, in this case, your OPP limits, but your PUA paid up additions rider limits. So the lower you squeeze down that base, the lower your cap on your paid up additions rider payments are. So you have to be very careful with that, because if you have a base policy that's too small, you're simply not going to be able to put in that much paid up additions. You just can't do it. And so I don't think this gets communicated very well by agents, because I see a lot of this, especially on YouTube, and these videos are like, you can put all this in and blah, blah, blah. So some carriers, what they will do is they will allow a policyholder to exceed the normal PUA limits if there is a term rider on the policy, but it's a temporary increase. They'll allow the policyholder to exceed the normal PUA limits until the term rider is paid off, and then it goes back to the default limit. So what will happen in these YouTube videos and stuff that I see is that the agent shows an illustration for the first 10 years on a Guardian illustration, for example. They'll show the first 10 years where you can put in, you can have a $5,000 base premium wise. So $5,000 worth of premium that goes towards the base, and then $50,000 that goes into, paid up additions. And they'll only show it for 10 years. Because what happens after the 10th year? Well, on the 10th year, Guardian says we're going to cap you out and you're only going to be allowed to put in 1 times your base into the paid up additions rider. They never say that in the video. Unless somebody questions them and they kind of push them in the comments section or something, but normally they don't say that in the video. They just show you the illustration on the screen, and they don't actually show you the illustration. They show it, usually it's like in an Excel spreadsheet or something. So they're not telling you, like, on the back end, you're going to be capped out on this on the back end. Or if it happens sooner, like if you get the term rider paid off in like after 7 years, let's say, then the PUA limits are going to drop back down to the default limits, right? So the idea behind that is so that carriers allow that exception so that you don't get stuck with a term rider where the term costs kind of get away from you, so that you always have the option to kind of quote unquote buy down the term so that you don't get stuck with it, right? So you're not just kind of capped out and then you're watching your policy implode. So a lot of them will allow that so that you don't run into that situation. But after the term rider's gone, or the term is paid off, then it goes back to those default limits. You don't want that to happen. So you have to kind of look down the road of, like, with Guardian, it's after 10 years, it goes from 3 times your base down to 1 times. New York Life, they have a schedule. So the product spec sheet for New York Life says the standard contribution limits on their OPP rider. In year 1, you can pay 10 times your base premium. In year 2, you can pay 8 times your base. In year 3, you can pay 6 times your base. In year 4 times your base. And in year 5 plus, you can pay 2 times your base premium. So if you start out with a really high PUA limit and say, oh, in year 1, you can pay 10 times your base, we can make a really skinny base, and then you can just pump this thing full of PUA riders. Realize in year 2, 3, 4, 5 that cap is coming down. The thing is on the illustrations with a lot of carriers, you can actually illustrate something that you can't actually do in reality. So they'll even generate a little like asterisk in some of these in all of them actually. Then they'll say, to make the planned premium that you want to make, you're going to have to go back to underwriting to get approval. Because it exceeds the policy limits. So you'd have to ask underwriting, go through underwriting again to get approval, and then hopefully you don't hit MEC limits and so on and so forth. So you got to be very careful on this. Yes, you could do a skinnier base and then you could put more PUAs in, but then you're going to hit policy limits. And then you might hit MEC limits because you're trying to sort of manipulate that death benefit as that term gets paid off. You got to be very careful about how quickly that happens, because if you might start putting in paid up additions premiums, and then before you know it, you're hitting TAMRA violations. Trying to stuff too much money in there. And so if you have a higher base, there's less risk of that. The other thing is with New York Life has other benefits besides just the cash value. So they tie their PUA rider limits to the base premium. So if your base is really small, after year 5, you're going to find that your limit on your paid up additions rider is going to drop way down, and then you're probably not going to be happy with the outcome. It's going to have the same effect essentially of suppressing later year cash values, because you pumped up the policy in the beginning. Now, if that's the way you wanted to do it and that's what you intended to do, that's fine. Some people want to put in, like, I want to put in big chunks of money in the first 5 years, and then after year 5, I'm going to curtail my premium back, and that's how I want it done. But if you're expecting I just want to be able to pay this for 10, 15, 20 years, and then chop it off and then use this as a long-term savings, it's not going to work that way. You're going to have more base. The other thing with New York Life's policy specifically, since this question referred to New York Life, the other thing with them is that New York Life has a very, very unique chronic illness rider. And that chronic illness rider functions very similarly to some of the dedicated LTC riders like that Mass Mutual has and some other carriers have. But the thing is that their chronic illness rider or their chronic care rider It's tied to your base premium. So it allows you to accelerate the death benefit on the base portion of the policy, but not the term part and not the paid up additions part. So if you go really, really, really small on the base, if you want to use that chronic illness rider, which a lot of people do, then you're sort of cutting yourself off later on down the road because you are not going to have a big base to draw your chronic illness benefit payments from. So if that's a value that you're buying out of the contract, you have to realize that you're not going to be getting as a big benefit from that when you go too small on the base. So it's more than just, just try to squeeze the base down and everything will be fine. And then just throttle the premiums right up to the MEC limits. It's a little more complicated than that. Just even if you're not even if you say, I'm not interested in the chronic illness rider and all this other stuff, you still have policy limits, you have MEC limits, and then you have to be cognizant of the fact that if you really throttle those PUA premiums in the early years, that you may be suppressing later year cash value. And it sounds counterintuitive, but if you take a more balanced approach, and lower and basically kind of lower the OPP payments or PUA premium payments, and then have a little bit more base in the policy and have it a little more evenly funded, that long term, like after 5 years, for example, or in Guardian's case, after 10 years, that you will be able to put in more premiums, even if you have to take like a 20 or 30 basis point hit. And it's usually that's what you're talking about. You're not talking about losing like a percentage point. It's usually like 20, 30 basis, maybe 40 basis points on the high end. If you do that, and you're like, okay, so I got to take like a 20, 30 basis point, you are still going to end up with more cash surrender value because you're putting in more premiums and you're not being capped out. In other words, your premium's not going from like $50,000 a year down to like 10 or 5, right? You could put in $50,000 a year level for 20 years, 30 years without running into policy limits or without running into MEC limits. Versus you put in $50,000 for 5 or 6 years, and then you're forced to drop it down to $5,000 or $10,000 as your cap, and then you got to ride that out for the next 20 years or whatever. That's not going to look so good, right? And it doesn't matter what your rate of return is. You're just not able to put enough premiums in to take advantage of it. So it's a moot point. It doesn't matter, So it's. Some of these design considerations, I think, are a little oversimplified. When you see agents on the internet doing these designs and so on and so forth. So to answer the question, like, do you need a term rider to make your policy more efficient? The term rider doesn't make things more efficient. The term rider lets you buy more paid up additions. And to do that, I think the answer to the question is sometimes. It works sometimes. On juvenile policies, it doesn't always work very well. In fact, a lot of times it doesn't work very well on juvenile policies or kids under 18. On adult policies, when you're in your 20s, 30s, 40s, it works pretty good. The older you get, the better it works, usually. When you're in your 30s, 40s, 50s, having a term rider lets you put on a lot more paid up additions, and that tends to work really, really well. To get more paid up additions into the policy and without, while avoiding those TAMRA violations, without hitting the MEC limits. So yes, conditionally it can help. But again, you got to be careful because if your base is too small, you might be capping yourself out on other benefits like chronic illness benefits, so on and so forth in the policy. And you might also just be capping yourself out policy wise, with the paid up additions rider limits. So again, it's not as simple, clear cut and dry as what I think what some of these narratives floating around the internet want it to be. Anyway, I hope that helps, and I will see you in the next one.
Okay, that's it for this week's question. If you'd like to add your question to the list, just drop them in the comment section or send me an email. And if you want more life insurance tips and advice, just head on over to monogenics.com, MONEGENIX.com, and sign up for my daily email list.